Good morning, traders. This is the second session, or probably the beginning of the foundation course. The session one, wherein I had explained to you about the course syllabus and what it entails. And now this is the second session, or the beginning of the course itself. This course has been developed keeping in mind that you are completely unaware of what a stock market is. We would be explaining simple to simple concepts to make you comfortable about the stock market in simple English, so that you will be able to gain knowledge. Plus, at the end of the course, you will be able to trade confidently. That is the whole aim for this foundation course. Now, this is a 16-hour course, as I've always told you, but it can lengthen depending upon the time I spend to explain each and every topic. In meanwhile, if you have any doubts on that particular session, I would encourage you to put that in the comment section so that I can clarify, or probably I can make an offshoot of that video, probably make a lengthier video on that particular word or particular topic as and when we progress. So if you're very new to the channel, I would request you to consider subscribing this and sharing it among your friends, because this is the place wherein we would be learning, as well as I will show you the live trades. How do we make the money, or probably how do we trade? Actually, not making the money. The idea is to know how to trade and how to make your own strategies. So that is the main idea of for this entire course. The session 2, we will understand what is a stock. Now this most of my sessions would contain more of whiteboard, because that's how I would be very minimalistic, or probably no animations. So if you are not able to focus, probably you can shift to another YouTube video where you can have animations and get entertained upon. But in here, I would be using the whiteboard, classical old method of teaching, so that you are focused and you learn more. That is the main motto for me, taking it into a whiteboard mode. So let us understand step by step. Now we need to know what is a stock. Now, when I say what is a stock, let me write this. And by the way, I would apologize before I start the session itself, because I was having cold and fever. I didn't want the classes to be delayed. That's the reason I am recording nevertheless. So probably after a few days, when I'm fine, then probably I might re-record it and post the video. But let us start understand what is a stock. Now, when I say a stock, before that, we need to understand how does one start a company. For example, imagine that your name is Ramesh. Now, you are Ramesh, and you want to start a pizza company. Probably you want to start something in the line of Pizza Hut. Now, you have calculated and you have understood that you need 10 lakh rupees to start this business of making pizza. Now, what happens is that you want to start this business, and the required fund is 10 lakh rupees. We always keep, whenever we give the examples, we keep it to the round number so that it becomes easy to understand. Now you have 2 lakhs, imagine, and you need 10 lakhs. So you're in deficit of 8 lakhs. Now there are two ways of procuring this 8 lakhs and starting the business. Either you go to the loan. Initially, what happens is that you go to your friends or parents and ask for a loan. Imagine that they give you, it's well and good. You have a loan. Whenever you take loan, there is an interest burden along with this. There is an interest burden along with whenever you're taking a loan. And then 8 lakhs, there is another method of funding this complete 8 lakh is you get in more partners. Now, whenever you are taking in more partners, what happens is that a partner owns a share of this, a particular share of the company. Imagine you have invested 2 lakhs and you are willing to forego 8 lakhs by giving away the share of the company. Probably you might have 8 people. 8 people might be interested in putting 1 lakh each. So these all are your partners, and they partly own your company, whatever you are starting with. Probably they might own 10% each. You might own 20% and they might own 10% each. Now what happens in here is there is no interest burden. There is no interest burden. The only thing you need to do is that whenever you make the profits, after taking out your expenses, the profit would be equally divided depending upon the share or the percentage of stock what they own, or the percentage ownership of the company. So this is a very simple way of understanding. Now what happens is, imagine that you there is a pizza, or example, let me say you 10 lakh rupees. Okay, 10 lakh rupees is there, or a pizza is, imagine this is a pizza, and I slice it to 1 lakh, 1 lakh pieces. Now what happens if I slice it to 1 lakh pieces? Each piece value is 10 rupees. Each piece, the value is 10 rupees. Let me tell you, this is the face value. When I start the business, this is the face value, 10 rupees. This, remember this face value and the market value, which we will be needing in the future of our course. So I'm trying to explain it in very simple terms. This is the face value of 10 rupees. Now what happens is that when the demand increases for this particular stock, and this, the valuation, probably now we started in 2024 and 2026, the valuation becomes 20 lakhs. The business is generating profit and the current valuation is 20 lakhs. Now what is each piece value would have increased to? The market value would become 20 rupees per share. So what is happening is that whenever the demand increases, why does the demand increase? Probably when demand increases because the company is making good profits, governance is good, and the people can see the foreseeable profits in the near future. They would like to be a part of the company. They would like to own a part of the shares, the own shares of this company. So what happens is that automatically there is an increase in demand. Whenever there is an increase in demand and the supply is limited, the prices are going to go up. And what happens on the other way around? The company is not making profit. Probably they just want to sell, and probably the initial investors who have invested in your company want to go and buy, probably make use of these funds to probably put in some other investment. When there's reduced demand and the supply being the same, or the supply increases, the reduced demand, supply increases, because so why is the supply more? Let us understand by keeping the supply constant. For instance, so reduce the demand, what happens is that the price decreases. When the price decreases, it means to say that the business is not now doing good. Probably they are not seeing a profitable future in the near term future, or your business is not doing up to the mark. So what happens is that the price decreases. Now the entire technical analysis focuses on this push and pull factors. We call it as push and pull factors. How the prices are going to go up, or whether the prices are going to go down. So this, eventually, whatever you see the price of a particular stock or the index, is an equilibrium between demand and supply. Whenever the demand increases, the supply being same, the price increases. Or when the demand is the same but the supply is less, again the price increases. When the demand is less, the price falls. So this we would be understanding. Now, when, see, imagine that the company has raised money, 8 lakhs from 8 different partners, and after certain stage they want to go into an IPO. What is an IPO? IPO is an initial public offering. I would not be going into the real depth of what is an IPO, what is the filing of the IPO process. That is not needed. If you are an intraday trader, if you want to become a professional trader, that much knowledge is not needed, or probably I might take it up in the near future. Now the company has raised money from the private investors, like Ramesh has raised money from 8 of his friends. Now he can see that the business is doing good. Now he wants to raise the money with by going public, in the sense, through initial public offering. He wants to list his stock in the exchanges. Now there are 2 exchanges, NSE and BSE, National Stock Exchange and Bombay Stock Exchange, with respect to India. This is an India specific training video, so we will be learning more of NSE and BSE. NSE is established in 1992, the most electronic platform. Here the Nifty 50 stocks are listed. BSE has more number of stocks are listed in BSE, more than 5,000 plus. And here the Sensex consists of T30 companies. NSE is by far most liquid, and say suppose if you are trading, or probably if you want to become a trader or a swing trader, particularly you are talking about the trading in NSE, National Stock Exchange. Both exchanges are in Mumbai itself. BSE was established in 1875. This is one of the Asia's oldest stock exchange. In fact, even the liquidity is increasing in BSE as well, and now the NSE as well. The NSE is liquid, is highly liquid. So these are the 2 exchanges we have, and now probably there are talks of going on to revive the Kolkata Stock Index as well. That we need to see. Now, if you want to get listed in IPO, initial public offering, what you are trying to do is that you are trying to raise the money through general public. Once it gets listed in the IPO, it becomes a secondary market. The shares are listed in the secondary market. Till the IPO, whatever the funds you are raising and the profits you are sharing, we call it as a primary market. The secondary market is when the stocks are listed on the stock exchanges, and the buyers and sellers can freely sell it in the secondary market to anyone through the help of the exchanges. It's all everything happens on electronic platform. So this is the secondary market for you. And now we know the primary market, we know the secondary market, we know what is the stock, and we know what is the face value, and we also know what is the market value of a particular stock. Now let us understand who are the market participants. Now in a market, when we understand, it is equally important to understand the market participants, because there are different participants with a different amount of money, probably different motivation and different period of interest or the time in which they are investing. We have the FIIs. This is a pyramid which shows them, which have the FIIs or foreign institutional investors or the foreign portfolio investors. These are the biggest movers, and this includes the global money as well. And the mutual funds houses, like we have the HDFC mutual fund, the SBI, or any mutual fund for that matter. These are the domestic institutional investors. They have large pools of money where they generally buy on dips, and they create support or resistance levels. HNIs are the high net worth individuals who have more investable funds with them, and they have the ability of moving the mid caps. And we have the operators also, and then we have the retail investors like you and I, who probably we react to the news and we trade using normal apps like Zerodha or a TradeSmart or a Grow app. And then we have the high frequency traders as well as the algo traders. Now, in fact, the FII sold so much in October in 2024, wherein the Nifty, which was trading at 26,200, came to 23,400. Now, still at the present scenario, we are hovering around 24,000. Now, DIIs provide the necessary support, because domestic institutional investors like pooling the money from different retail investors in themselves, and they provide support to the market. What happens if DIIs and FIIs both start selling? Then you would have a large sell-off. When DIIs and FIIs are both putting in the money, then you see the market going up, the market rallying. So we are, as a retail trader, we should understand what is the behavior, and we will understand what are the support levels and the resistance levels in which we should be trading. We always must act like a DII or an FII when we sit to trade. If you act like a retail investor, probably that's when there are chances of you losing the money. These are the retail investors. As I told you, the market participants, I have just explained it to you in a tabular column. Retail investors like you and me, individual traders with a small capital, we have the time horizon is usually days to years. Most probably people react to the news, people buy on news. Many times we have seen that when the news is good, the market, this particular stock has fallen because of the profit booking. You might think that you are a smart one, but there are people who would have accumulated it 3 months or 4 months before itself in anticipation of this news. Now, there is a saying that you buy on rumors and you sell on news. That's very apt for the stock market. So don't be shocked when you see that the company has come up with fantastic results, but the company is going down. The price of the company is going down because this is profit booking. Similarly, you expect one political party to come out with a majority on an election day or any state election or a national election day. The exact party comes to power as well, but the stock market, which would have rallied in the anticipation of this result, would start profit booking on that particular day. So I would definitely tell you, jinx the news. You don't have to watch the news. You don't have the news running in front of you 24/7 when you sit for trading. Everything is factored in the price itself. We say price discounts everything. Whatever you are seeing in the price of a particular stock or the index is the net effect of all the demand and supply, and it has assimilated all the news, thinking that the market is an efficient. We assume that the market is efficient. HNIs are the high net worth individuals with large disposable income or large disposable investable capital. They have an objective of time horizon is weeks to months, can move mid cap stocks very significantly. Mutual funds, as I already told you, pool the money and months to years buy on dips and create support levels. FIIs or FPIs, foreign institutional investors, so the global money months to biggest movers of the Indian market. Now, operators are the large traders of the groups with concentrated positions. Go and check the Jane Street about the Jane Street, what they have done or with the Indian stock market, and understand how an FII can influence the market positions and probably ruin the capital of the retail traders. Biggest movements of the biggest movers of the Indian market. And operators and large traders or groups create traps, understand their footprints. They create traps. That's what I was telling about Jane Street. High frequency traders in the algos, microseconds to seconds to time horizon, they provide liquidity and dominate the order flow. And now there are many apps which provide you the algo trading facility. Now you don't need to have a strategy. Probably you can implement their strategy and you can run. Even TradeSmart provides you with the algo strategy. And if you want to open an account with TradeSmart, you can just send me a comment and you'll be guided. The team will help you to open the account with TradeSmart and help you in starting your trading journey. So the next session we'll be understanding what are the market timings and the key indices, and we'll progress further. I'm deliberately keeping the session short, about 15 to 20 minutes, so that your concentration doesn't get deviated. This might look very simple and basic to you if you're already in the market. So this might seem very simple to you. This course has been designed particularly keeping in mind that you are very new to the stock market and you don't know ABC of it. That's it, and the next session we will we'll learn much more things about the stock market. Thank you, and your wonderful trading days ahead. Bye bye.